Good morning and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's take a look at what happened overnight. Global equity markets turning negative as bond yields rose and oil prices surged amid heightened tensions in the Middle East. On Wall Street, the main indices finished lower after economic data showed strong service sector activity, while investors are also waiting on tomorrow's non-farm payrolls data. The mega cap tech stocks were mixed, Nvidia gaining while Tesla proved to be a drag. Energy shares, they gained with the sector rising more than 8% over the past 5 sessions as hostilities in the Middle East push crude prices higher on the potential threat to supplies. And shares of the gold miners fell, tracking the price of bullion lower on expectations of another big cut to US interest rates, which, well, they've faded to a degree. And the copper miners also fell, tracking the commodity price lower, which has been dragged down by a strong US dollar and uncertainty about how soon China's stimulus measures would affect physical demand. US listed shares there, BHP and Rio, both falling. And Constellation Brands shares falling after the beer maker maintained its sales and profit forecast for fiscal 25. Well, the US services sector activity jumped to a 1.5-year high in September amid strong growth in new orders. The Institute for Supply Management Non-Manufacturing Purchasing Managers Index accelerated to 54.9 last month. A PMI reading above 50 indicates growth in the sector, which accounts for more than 2/3 of the economy. US Treasury yields climbed off the back of that data, the 2-year rising close to 6 basis points to 3.7% and the 10-year climbing to its highest in a month at 3.84. In other US economic data, the number of Americans claiming unemployment benefits rose last week, although Hurricane Helene and strikes at the East Coast ports in the States are seen as distorting the labour market picture in the near term. The workers' strike has, in the ports, there has entered its 3rd day, and Morgan Stanley economists have said a prolonged stoppage could fuel inflation, with food prices likely to rise first. Meanwhile, the US dollar, that's risen to a 6-week high as data showed a resilient US economy. The Aussie falling back to 68.5 US cents. Checking in on the commodities overnight, oil prices have surged on concerns about a widening regional conflict in the Middle East, which could disrupt global crude supplies. And the market is considering the possibility that Israel may target Iranian oil infrastructure, with US President Joe Biden saying he's discussing that with the Israeli government. Brent crude futures up 5% to $77 a barrel. Copper has tumbled more than 2%. Iron ore is up around 0.5% to $108 a tonne. And the gold price slightly weaker at $2,655 an ounce, with its safe haven demand offset by a stronger US dollar. Bitcoin, that remains below 61,000 US dollars. Well, let's get across what is moving those markets, what we should look out for. Morningstar's Chief US Market Strategist, Dave Sekera, joining us now. Dave, terrific to catch up with you again. Thanks for joining us.
Of course, always good to speak with you, Andrew.
Indeed. Well, we love to get a view of what you're seeing in the market at the moment. Let's begin then with how you're seeing those valuations more broadly on the market.
Yeah, I mean, the US stock market right now, I would consider really to be priced to perfection. So when we put together a composite of those over 700 stocks that we cover that trade on US exchanges, it's trading at a 3% premium to those fair values. Now, 3% may not necessarily sound like much, but when I look back to 2010, since then, only 15% of the time has the market traded at this much of a premium or more. But really, I think what's important for investors really to be focused on right now is underneath the surface that it appears that the AI trade, for the most part, is over for now. What we've seen since July is really a rotation into small cap stocks and into value stocks. And according to our evaluations, we think that trend still has further room to run.
All right, we'll come back to the small caps in just a moment. Overall, when you look at the broader market, how would you weigh up those headwinds and tailwinds? What are you seeing there at the moment? Obviously, we are seeing those. The interest rate cutting cycle is now underway, given inflation has moderated, and of course, also we've had that stimulus from China as well.
Exactly. Yeah, when I look at the market dynamics out there right now, and again, things are a lot different now than they were at the beginning of 2002. When I look at inflation, that's still moderating. In fact, we're looking for inflation to drop, below the Fed's 2% target next year in 2025. Yeah, we think that we're still kind of at the beginning of a multi-year decline in long-term interest rates. Our U.S. economics team is looking for the 10-year to drop to an average of 3.5% next year, getting down to 3% in 2026. Of course, we've got easing monetary policy with the Fed having cut 50 basis points. We expect two more cuts here over the next two meetings. And we think that they have much further to go over the course of 2025. By the end of next year, we're looking for the Fed funds rate to be 3.75% range. As you noted, you've got the big Chinese fiscal and monetary stimulus programs out there. So even though we have the headwind of a slowing rate of economic growth here in the US, I think those tailwinds probably overwhelm those headwinds. We're looking for the rate of growth to slow the next couple of quarters, but we're still looking for that soft landing.
So, Dave, overall, you mentioned that rotation into small caps. Given your portfolio positioning, then, where are you overweight, where you're underweight?
Yeah, so I still think that the small cap is the best place to be by capitalization. So that's, in our view, definitely an overweight at this point. When we look at our valuations there, the small cap universe is trading at about a 15% discount to fair value, still very deep into undervalued territory. By mid cap stocks, those are probably only trading pretty much close to fair value, maybe a very slight discount at this point. So I think that's a good place to be market weight. And of course, in order to pay for that overweight in small caps, I think you need to be underweight large cap, especially large cap, growth stocks at this point. Large cap overall trading at a 4% premium, and large cap growth trading well into the double digit premium over our fair values.
Dave, can you give us an example of where you're looking for in small caps at the moment? Perhaps which stocks you're finding attractive?
Sure. There's a handful that we've been highlighting recently. The first one is Bath and Body Works. It's a five-star rated stock, trades about half of what we think that company is worth. Now, it has been under a lot of pressure. We've seen consumers in the U.S., pulling back on discretionary goods. But at the end of the day, we look at Bath and Body Works product of portfolios being considered by consumers, an affordable luxury. And as we go into the holiday season, our team is looking at their product portfolio, really looking to say that, what they have to offer are pretty gift worthy, type of items. They have a lot of different accessible price points. So for the most part, we think that for the second half of this year and going into next year, they probably should hold their own as far as, this weakening consumer spending environment. And then we're looking for, more strength in 2025 as wage income comes back.
Now, I see in terms of style, you're overweight value, underweight growth. Why is that?
Well, it's really all about valuation at this point. When we look at style, I would note that value is still trading at a 3% discount. Again, maybe not a huge discount because it has moved up, but that's still relative to the market, a much better discount where you can still find value today. Core stocks trading at a slight premium, that's probably a market weight for the most part. And like I said, I think you got to be underweight growth stocks. Those are trading at a 13% premium. And when I look both, at, really what's going on there, they are trading on an absolute basis, better than the market, and on a relative basis, certainly much more undervalued than what we see in other areas.
And Dave, once again, what are some of those examples of value stocks that you're liking at the moment?
Yeah, I've got a couple here for you. First one is going to be Kraft Heinz. That trades at a 40% discount, pays a pretty healthy dividend yield of 4.6%. It's a five-star rated stock. We recently upgraded our economic moat rating to narrow on that company. And what I really like here is over the past couple of years, the companies really look to switch their strategy to drive, long-term growth. Really, in the past, the company had been chasing short-term earnings, in really at the expense of their brand value. So that is behind them. We're looking for, better margins going forward there. Another interesting one for global investors is going to be Bristol Myers. It's a four-star rated stock, trades at about a 16% discount. And I think the market is just too focused on this year's earnings. There's going to be some accounting treatment in there for an acquisition that's temporarily lowering earnings. When we look at 2025 earnings, really that to us is much more of a normalized earnings power of this company. It's only trading at 7 times our 2025 projected earnings. So to me, that's really a deep value stock. And it's getting a little bit of a lift right now. They recently announced approval of a drug for schizophrenia. So again, I think that's kind of indicative of the market underestimating this company's pipeline.
Dave, sector-wise, which ones are most undervalued, do you think?
Communications is the most undervalued, trading it at 15% discount. Now, of course, you can't talk communications without talking Alphabet. That company just still continues to be hitting on all cylinders. We bumped up our fair value to $209 US a share. We think the market is being just overly pessimistic regarding some of their antitrust issues. So that's a four-star stock at a 21% discount. And we still like a lot of the more, traditional wireless, traditional communication companies. Verizon is still the go-to stock there. In my mind, it's a four-star rated stock at a 16% discount. Really, what we're seeing is that the wireless industry in the US is becoming a bit more like an oligopoly, and we're starting to see this start to play out as their margins are improving as those companies compete less on price.
Now, how are you viewing energy at the moment, Dave, particularly given what's going on in the Middle East with the threats, and we're hearing that overnight outtime, particularly to those Iranian output, particularly if Israel chooses to strike those that infrastructure. Overall, what are you seeing in the energy space?
Yeah, we've actually been overweight energy here for a while. Energy has struggled in the US, as compared to a lot of the other sectors, thus far this year. Currently trades at an 8% discount to fair value. What I really like about the energy sector from the stock point of view is we're actually relatively bearish on the price of oil. We look for West Texas Intermediate over the long term to actually fall to $55 a barrel by the end of our forecast period. But yet, these stocks, even when you put that into our models, are still undervalued. You can still buy them at a pretty good discount from our intrinsic valuation, which of course it means, if oil stays here or to move higher, there's a lot of upside leverage. Plus, as you mentioned, which is the geopolitical risk going on, I think that's a good natural hedge in your portfolio for heightened geopolitical risk, or if inflation were to make a comeback. The two stocks I would highlight here, first in the global majors is going to be Exxon. It's a four-star rated stock at a 14% discount. And then looking more at some of the domestic US companies, I would highlight Chevron, another four-star rated stock at a 16% discount.
And Dave, just briefly, how much of a risk is this port strike we're seeing on the East Coast, particularly in terms of the hit potentially to the US economy and inflation?
I'm actually just starting to hear before you and I got on this call. It looks like they're getting to a tentative agreement and that they're putting that in place. So I think as that agreement is put in place, that strike is going to be called off here in the short term. And I think they're going to give themselves until January of next year. Now, that had actually been our base case. Our US economics team, wasn't really necessarily concerned that there would be a meaningful impact on the economy so long as this didn't drag out, for too long. So it looks like, fortunately for us here in the US, that is starting to play out.
Dave, great to get your perspective from Morningstar as usual. Thanks so much for joining us.
Of course, thank you.
Quick check of where we're likely to get going in just a couple of minutes' time, and looking for a negative start. SPY futures off around 1/3%. Stay with us because the open is a couple of minutes away.